Why do so many traders lose money while only a few consistently succeed? The answer is simple but often overlooked. It's not about finding the perfect trade or chasing huge gains. It's about protecting your capital above all else. Without protecting your account, winning trades don't matter. Today, we're going to dive deep into risk management techniques that have helped market legends like Jesse Livermore, Mark Minervini, and Kristjan Kullamägi survive and thrive in the markets. These rules aren't just old wisdom. They're the foundation of every professional trader's toolkit. Now that you know why protecting your capital is the key to long-term trading success, let's break down the essential steps we'll cover in this video to help you master risk management like Jesse Livermore himself. First, we'll show you how to always use stop-loss orders to cut losses quickly and avoid big hits. Next, we'll dive into position sizing, how much to risk on each trade so you never expose yourself to ruin. Then, you'll learn the power of patience by waiting for high-probability setups instead of chasing every market move. And finally, we'll discuss how emotional discipline keeps you focused and prevents reckless decisions. Stick around, because mastering these steps will transform the way you trade and protect your hard-earned capital. But before we get into legends, let me introduce myself. I'm Henry, Henrik's AI twin. I handle the math, he handles the comments. Fair trade, right? Now, what's on your mind? Jesse Livermore, one of the greatest traders of all time, famously said that the key to making money is not how much you make on a single trade, but how well you protect your money. Capital preservation ensures you live to trade another day. When you lose big on a trade, not only does it hurt your account balance, but it also chips away at your confidence and mental edge. That's why Livermore and successful traders always cut losses quickly. One of the cornerstone rules is to always use a stop-loss order. This is your safety net. Decide before entering a trade how much you're willing to lose and stick to it. No exceptions. A stop-loss keeps emotions out of the equation and prevents devastating losses when the market moves against you. Imagine you buy a stock at $100 expecting it to rise. Without a stop-loss, if the price suddenly drops to $90 or even lower, you risk losing a large chunk of your capital. But by placing a stop-loss order at $95, you automatically limit your loss to 5%. Let's look at a recent real-world example to see why stop-losses are vital. In August 2025, Nvidia's stock dropped about 12% in just a few days after news broke about a competitor's aggressive pricing strategy. This sudden sell-off caught many traders off guard. If you were holding Nvidia shares without a stop-loss, you could have seen a significant hit to your account, potentially losing over 10% of your investment in days. But by placing a stop-loss order at a level like 5% below your entry price, you would have automatically exited the position before the sharp decline got worse. This kind of risk management protects your capital and lets you avoid panic selling. It's a crucial rule, especially in volatile sectors like technology, where news can quickly change the market landscape. Remember, stop losses aren't about fear, they're about smart trading discipline, preserving your funds so you can stay in the game and trade again tomorrow. And the truth is, you never really know what tomorrow will bring. Losing a little to a stop loss and then re-entering at a better stage is a small price to pay for staying alive in the market. Think of it this way. The cost of using a stop-loss plus the opportunity to re-enter later is one of the safest and most cost-effective ways to handle risk in this unpredictable market. Once you've set your stop-loss, the next crucial step is deciding how much to risk on each trade. This is called position sizing. Even the best setups can go wrong, so managing how much capital you expose to risk on any single trade is essential to protect your overall portfolio. Let's say you have a $10,000 trading account. A common rule among professional traders is to risk no more than 1 to 2% of your total capital on any single trade. For this example, let's risk 2%, which is $200. Now, suppose you want to buy a stock priced at $50 per share. You decide your stop loss will be at $45, which is $5 below your entry price, meaning you risk $5 per share. To calculate the maximum shares you can buy without exceeding your $200 risk, divide your risk amount by the difference between entry price and stop loss, $200, $5 40 shares. This means you buy 40 shares, risking a total of $200. So if the stop loss is hit, you lose only 2% of your account. This way, losing trades won't wipe out your capital and you can continue trading. Now imagine ignoring position sizing and buying 200 shares at $50. If the price hits your $45 stop loss, you lose $1,000, 10% of your account, instead of the manageable $200. That's a huge hit that's harder to recover from. Position sizing keeps your downside limited and your emotions in check. When losses are small, it's easier to stick to your plan and avoid costly emotional decisions. Remember, position sizing tailored to your risk tolerance is the secret behind steady, sustainable growth. It's not about risking everything on big wins. It's about surviving the losses and letting the winners run. One of the most challenging yet crucial traits for successful trading is patience. Many traders lose money simply because they jump into trades too quickly, chasing every small move or tip that comes their way. Mark Minervini, one of the market's greatest traders, often emphasized waiting for clear, high-probability setups before committing your capital. Not every price move is a trade. Waiting means you only enter when the odds are in your favor. For example, imagine a stock that has been moving sideways for weeks. Instead of buying randomly during this consolidation, Livermore and Minervini would wait for a breakout above a key resistance level, signaling a strong trend. Look at this chart. The stock struggles to break above 334 multiple times. Finally, when it breaks that level on heavy volume, that's a high probability setup signaling strength. Entering here reduces your risk and increases the likelihood of a profitable trade. Real trade of ticker ALNY. Contrast this with impulsive trading, buying during the sideways moves or minor rallies. This increases your risk of a false breakout or quick reversal, often leading to losses. See here how entering before the breakout leads to a drop below your entry price, triggering a stop loss or emotional exit. Patience also means accepting that you won't trade every day or even every week. Sometimes the best move is no move, sitting on the sidelines until the perfect opportunity arises. Remember, consistent profits come from quality trades, not quantity. Waiting for the right setup helps you manage risk, improve win rates, and build confidence. So, train yourself to recognize high-probability setups, key breakouts, trend confirmations, and price patterns backed by volume and momentum. Trade less, trade better, and watch your results improve. One of the biggest challenges traders face isn't the market itself, it's controlling emotions. Fear and greed can sabotage even the best strategies if you don't stay disciplined. Emotional reactions like panic selling after a small loss or chasing after a trade to recover losses often lead to reckless decisions that magnify losses. This is what separates professional traders from gamblers. For example, imagine you bought a stock and it dips briefly against you. A common temptation is to sell immediately out of fear. But if this dip is within your stop-loss limits, holding steady is often the wiser move. Conversely, chasing after a losing trade by increasing your position size, hoping to win it back, is a classic mistake driven by greed, and it can quickly wipe out your account. The key is to have a clear, predefined plan and stick to it. Know your entry, stop-loss, and exit points before risking any capital. Trading according to a plan helps you remove emotional impulses from the equation. For instance, if your plan says to exit at a 5% loss, execute that without hesitation. Overriding your plan because you're hopeful the market will reverse turns a small loss into a catastrophic one. Building emotional discipline takes time and practice, but it's essential for long-term success. Techniques like journaling trades, mindfulness, and pausing before acting can help keep emotions in check. Remember, consistent profitability isn't about avoiding losses. It's about managing them calmly and staying focused on the bigger picture. Check my video about journaling. The link is in the description. By mastering emotional discipline, you turn trading into a controlled, strategic activity, not a roller coaster of fear and greed. All right, let's quickly recap the 4 essential steps to protect your capital and trade like a pro. Step 1. Always use stop-loss orders to cut losses quickly. Step 2. Size your positions based on your risk tolerance. Never risk what you can't afford to lose. Step 3. Be patient and wait for those high-probability setups, quality over quantity. And Step 4. Master emotional discipline to avoid reckless moves driven by fear or greed. If you can master these, you'll not only protect your money, you'll build the mindset that separates traders from gamblers. Now, if you enjoyed this video, do the trader's version of a high five, hit that like button, subscribe for more wisdom that won't cost you a dime, and share this with a friend who needs a stop loss in their life. And hey, don't just be a silent trader. Drop a comment below. Tell us your biggest trading challenge or your best stop loss saved me story. We love hearing from you. Thanks for watching, and remember, the market rewards the disciplined, the patient, and the prepared. See you in the next trade.